Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have CEO Bill Crossland to provide an update on thermal energy. Thermal energy trades on the TSX Venture Exchange under the symbol TMG and on the OTC under TMGEF. The company is trading at 17 cents with roughly 160 million shares outstanding, or about a $27 million market cap. I'd now like to hand it over to Paul Andriella.
Awesome. Thank you, Trevor. Happy to have Bill back. We spoke with you a good 6 or 7 months ago, but obviously a lot has transpired since then. You just put out your Q2 numbers yesterday, and the market responded quite well. So happy to have you back, and happy to have you give us a bit of an update. But why don't we start with a little bit more of a general summary on exactly what thermal energy is all about.
Yeah, absolutely. So I will share my screen, and okay. Thank you. Can you guys see that now?
Sure can. Yeah.
Let me just go to slideshow. Okay, thank you, Paul and Trevor. I'm happy to be back, and would look forward to telling everybody a little bit more about what we've been up to for the last 6 or 7 months. But before we do that, just to give everybody a quick refresher, thermal energy is in the energy efficiency space. So it's an enormous global market with very strong fundamentals. And why energy efficiency? And quite frankly, that's because it's by far the fastest, cheapest, and most significant way to reduce carbon emissions, much greater than renewables. And why is it so significant? Well, if you look at the slide here, you can see that as a society, about 2/3 of the energy we use is lost somewhere in the system due to inefficiency. And in the industrial sector, about 50% of it is lost somewhere due to inefficiency. So we focus on the industrial thermal side of energy efficiency. When I say thermal, that's heat energy. That's where they're burning something. So you've got thermal energy and you've got electrical energy. We focus on industrial thermal energy because that tends to be, on the industrial side, that's where there's large, very energy intensive sites. So they're using lots of energy. So there's lots of energy we can save them. Nice big projects. And on top of that, about 88% of industrial energy use is thermal. So it's the majority of it. They don't use nearly as much electrical. And the industrial sector energy use is about 2 times the size of the residential and commercial. That's why. And then also it's interesting to highlight that one of the real benefits of energy efficiency is not only does it reduce carbon emissions for our customers, but it saves them money, improves their profitability, makes them more competitive. And there isn't a government in the world that doesn't want to encourage their domestic industry to become more competitive and reduce their costs. So, everybody wants to increase the energy efficiency of their economies. The global market for TER products is about $250 billion, which just means that we've barely scratched the surface. So lots of upside. The next slide talks a little bit more about us. So thermal energy, just as a reminder. So we design, deliver, and engineer custom turnkey energy efficiency projects based on our proprietary technology. So you can see them there, our GEM steam traps, our heat sponge heat recovery units, Flu-Ace heat recovery systems, Dryrex. So we use our proprietary products. So every project that we do, and about 70% of our business is turnkey solutions where we design and install it. The other 30% is where we just, the customer just wants the piece of equipment. And you can see that these sustainability products pay for themselves with paybacks of about 2 to 5 years. And this is equipment that will essentially last forever as long as the plant is there, 20, 30, 40 years, no question at all. And we deliver our business through an established global footprint. We have corporate offices in Canada, the US, and the UK. Our key markets are North America and Europe. That's where we're focused. We have best-in-class product with worldwide application, but we focus on North America and Europe for now. We have sales offices, that is people on the ground, salespeople on the ground in 7 countries, completed hundreds of projects across the globe, extensive list of leading multinational customers in a wide range of sectors, and we've had over 10 years of proven successful growth in operations. And then just to give you a little bit more about, the type of customers that we target. So primarily it's large multinational customers, and that's intentional on our part because A, they have large energy intensive sites, and B, they have multiple hundreds of sites around the world where we can get repeat sales. So typically our customers are very large multinationals with hundreds of sites around the world. We're in a wide variety of sectors, but about 80% of our business is essential non-cyclical sectors such as food and beverage, hospitals, and pharmaceutical. And we're delivering, real compelling investment rates of return for our customers. This slide, excuse me, highlights a couple things. These are sort of a selection of orders that we've announced over, say, the last 12 months, and it highlights three different things. First of all, the variety of sector. So that first one, little can with a fish, it was canned products. The next one's a hospital, then tissue, then a dairy industry, then a brewer, snack food, tires, pet food, chemical, and I can't see what the last one is, but because it's the Zoom screen is blocking it. And you can see the paybacks range from about 1.5 years to 4 years, and you can also see a variety of location between North America and Europe. Again, those are our two key markets. And we're just getting started with these customers. They have hundreds of sites around the world. So we have been growing the company successfully for the last 5 years with an established growth strategy. And that basically is leveraging off our existing high quality customer base. I often joke with our sales team. I say, we don't need any new customers. We just need to sell more to our customers we already have. And that's true. But, I also encourage them to find new customers. We want to increase our portfolio of proprietary complementary products, and we want to grow our team and our global presence. So after the last couple of years, we grow our global presence by putting salespeople on the ground in different territories. So the last couple of years, we've added 2 people in Germany, somebody in Poland, somebody in Latin America, as an example. And we want to do all of that, and we have been doing all of that, both organically and through accretive acquisitions. So you can see the results since 2015. Right up to February 2020, so over 5 years, we had about 30% compound annual growth rate on revenue, and 50 to 60% compound annual growth rate on profitability. So revenue for the LTM, the last 12 months ending February 2020, was about $25 million with almost $3 million in EBITDA and almost $2 million in net income. Now I picked February 2020 for obvious reasons. It was in March where the global pandemic was declared. It's interesting to point out, we did see a slowdown even before the pandemic was declared. So probably 3 to 6 months before that, we noticed our customers starting to slow down a little bit because things were happening. But certainly once the pandemic was declared, it was, travel restrictions, customer lockdowns, economic slowdown, significant economic slowdown. We all lived through it. We all know. But everything we do, or most of what we do, relies on site visits. We have to go to site to design the system. We have to, oversee the installation of the system. So back in March, April, May, June, there was travel restrictions and our customers basically shut down their sites. So it was a very difficult situation for us right back then because we couldn't get to our customer sites. So we still had some orders we could fulfill because we were just shipping product. But those, 70% of our business, which is turnkey solutions, basically ground to a halt. Well, what did we decide to do back then? And this is where the story takes off from our last time we talked. We decided to make the best of a bad situation. We had spent the last several years establishing a phenomenal team and training a team. When we hire new salespeople, it takes about 2 years for them to get up to speed, and new engineers take about a year because everything we do is unique and customized. So we decided we were going to use the downtime to increase staff training and knowledge transfer. And we also immediately rolled out some digital system upgrades, which we had been planning, but we accelerated them to do them right away. And that basically consisted of everybody in the company immediately got Office 365, Microsoft Teams, and SharePoint. That allowed people to work remotely, to share work remotely, and to collaborate. We also developed a TEI portal, which was sort of the new virtual office for the company. That's where all the centralized files were kept, centralized resources, workflows, activities, as well as social activities, news, company news, that was all there. And we developed a new learning center. As I said, we've added a lot of new engineers and salespeople over the last few years. We've grown our product portfolio. So we saw this as a unique opportunity to train everybody on the new products. Often some of these new products or applications was only really known by 1 or 2 people. We wanted to spread that knowledge and capture it and transfer it to everybody else. So we did over 75 in those slow months. We did 75 training sessions. We basically had one going every day. That was over 120 hours of training. That's all now on our portal so that the team can go back and review it over and over again. So the objective was, these enhanced systems and capabilities, we wanted to prepare ourselves for full capacity and the new normal when things returned to sort of normal, or at least to the new normal. So we, not only is our industry talking about build back better, we wanted thermal energy to build back better as well. So, and then we've also seen in terms of the market since June, and since the first wave of the pandemic, when everything basically shut down, there's been unprecedented growth in the demand for sustainability. We've seen it everywhere. We've seen it from citizens, governments, customers, industry. You know, this is just a few of the headlines that have come out over the last little while, but basically every country in the world has renewed their commitment and increased their commitment to cutting carbon emissions, including now the US. You know, you see things like the incoming White House team represents the most robust climate-focused team ever assembled. You know, one of the first things Biden did was rejoin the Paris commitment. Just recently, you know, Europe already had some pretty aggressive targets to reduce carbon emissions. They were at 40% of 1990 levels by 2030. They increased that to 55%. The UK increased theirs from 40% to 68%. And then more recently, I mean, this has been building, but just in the news in the last little while, BlackRock Asset Management, the world's largest asset manager. Every year they put out a report to the CEOs. You know, this is a company that manages $9 trillion. And they're urging all their investee companies to disclose more and do more with respect to greenhouse gas emissions. And interestingly, that very same day, Bank of America, KPMG, MasterCard, and 60 other major companies announced new environmental metrics reporting. You know, so this is something we're seeing, you know, very strongly. Our customers have a renewed focus right now to really reduce carbon emissions, and that's going to benefit us going forward. So what we have seen since June is, you know, a sort of starting in July and August, where some of the travel restrictions were reduced and site visits resumed. We were able to finish some of our projects. So, you know, with respect to a build back better approach and pent up demand, we've seen a strong rebound in orders since June. So our year end is May. So from June 1st to November, so that's the first 6 months of the year, orders are 60%, our order intakes, the orders received are 66% higher than they were at this time last year, and higher than the year before, which was a record. So last year, the orders in was a little bit lower because there was a bit of a slowdown for the last 6 months prior to the pandemic, but orders in now are significantly higher, not only of last year, but also of the year before. You know, but there was some difficult quarters there. So if you see this chart, I took the $6.2 million in revenue. That's the average quarterly revenue for the previous 4 quarters, ending on just before the pandemic. So our quarterly revenue averaged $6 million prior to the pandemic. Then when the pandemic hit, it dropped to below 3 for a couple of quarters. So Q4 is basically March, April, and May, and Q1 is May, June, June, July, and August. But what we saw in Q2, because by the end of the summer, you know, travel restrictions eased, we were able to get a lot of our projects done and get back to sites. So revenue rebounded quite strongly, almost up to the point of the pre-pandemic levels. Same with gross profit. We saw the same thing. You know, it dropped for those 6 months during the worst of the pandemic, but already in Q2, we're now coming back strongly. We're back very close to pre-pandemic levels already. From an EBITDA standpoint, it gets even better. You can see obviously when revenue drops, your EBITDA drops pretty precipitously. So our EBITDA average for the previous 4 quarters prior to the pandemic is about $700,000. It dropped pretty close to 0 for a couple of quarters. It's now back up to $800,000. So it's actually higher. This last quarter was higher than it was pre-pandemic. And the same with the net income. So net income pre-pandemic was about $400,000 per quarter averaging. In the 4th quarter, we did take a one-time charge on intangible assets, and you have to remember that was March, April, and May. Nobody really knew what the impact was going to be of this pandemic at that time, so we did take a charge at that time, but fortunately, things have come back strongly ever since. So for the 2nd quarter, we had about almost $600,000 in net after-tax income. And working capital remains exceptionally strong. So we're in a very strong position, both from a working capital and a cash position standpoint. You we're here to weather the storm. The next couple of months may be difficult with the COVID cases. They did go up. They're now coming back down, but we're in a strong position to weather whatever happens, and we're feeling pretty positive about the future and the position we've put ourselves in. Not only because we built a much stronger company, we used the downtime to build a much stronger company, but we retained our cash and our liquidity, and we're in a very strong position to handle whatever comes, whether that's more growth or a couple of slow quarters. And then you see here the order intake again. So the order intake for the first quarter in June, for first quarter, that's sort of June, July, August, very strong. Some of that is pent up demand because basically the economy and all our customers shut everything down in March, April, May. So some of that's pent up demand, but you can see, even for Q2, we're above where we were pre-pandemic. So we're feeling pretty positive about that. So that's the quick story, just a summary. I mean, the stock is down a little bit today. It was up at it closed yesterday at 20.5 cents. That indicates, a market cap of about $32 million, enterprise value of 31, because we do have some debt, but we have net positive cash. And so our enterprise value to revenue is only 1.3 times, debt enterprise value to EBITDA 10 times, and PE multiple 19 times. Now, these are the multiples assuming our pre-COVID performance. We're not looking at what our performance is right now, but we're saying, look, we're pretty close to getting back to pre-COVID performance where we were and continue growing from there. And if you use those, it's pretty compelling, multiples. If you compare this to any of our comparables, an investment, dealer forwarded me a comp chart that they had done recently, and virtually everybody else, whether you talk at the likes of Zeebeck or Green Lane, they're sort of at 20 times revenue and 50 times EBITDA. So we think that Thermal Energy's current valuation doesn't reflect either our proven growth and profitability story and our future potential, as well as the expected market improvements that we think are coming our way as a result of a Build Back Better in all of our key markets. So that's about it. I'd be happy to answer any questions.
Awesome. Thank you so much, Bill. Apart from your Q2 numbers, you also announced a couple of sales in the past quarter. Maybe talk about some of the new orders you got, and do they open up to new industries or new opportunities? Tell us what you can.
Yeah, so there's three orders that we have announced since May, since we talked last. One was a protein company, that was a meat company, that was in June, and that was a new customer. And that was, like I've said, we were able to do that one because, as I mentioned, 70% of our revenue is turnkey solutions where we design and install on site. But we do sell, sometimes the customer just wants some equipment. That was one that was just equipment. So that's how we were able to, in the heat of the pandemic, able to get that one out. Then there was one in August, which was a food products company. That's a repeat customer. So that's our second project with that customer on the same site. And we've got a couple others on that site as well. And then the most recent one that was just a week or so ago was a hospital. And that was in Canada, and that was a repeat customer as well. It's a customer we dealt with a few years ago. And interestingly enough, that was equipment. That one was equipment only as well.
Mm-hmm. Perfect. I mean, we're still in the middle of the COVID pandemic. There are still various travel restrictions. How are you guys managing right now with the restrictions out there?
Yeah, good call, Paul, because I ask my sales team every week on the sales call and my engineering team every week on the engineering call what they're finding. And it has gotten, just very recently, gotten more challenging. But interestingly enough, back in March, April, and May, there was travel restrictions, but also customers were not allowing you on site. Mm-hmm. Customers will now allow you on site. They don't have an issue with it. Everybody has the mitigation measures. They take the measures in place. They're considered essential. We're considered essential because we're servicing them. So, if we can get around the travel restrictions, we can still get to site. So we've had, over the last couple of weeks, we've had guys, engineers from Ottawa travel to a couple of different US states, but it is an evolving situation and it's sort of state by state. and it is getting more challenging in Europe. But we have feet on the ground in North America. I'm sorry, in the UK, Ireland, Germany, Poland, and Italy. But Germany in particular has had some recent restrictions. So we're monitoring it. So far, I don't think it's going to be nearly as bad as it was in March, April, and May over the next couple of months. I think we'll get through it, but it is creating some challenges, and we'll just sort of have to take it as it comes.
Now, what I found interesting is you guys actually had a smaller, smaller revenue for the quarter compared to what you were doing pre-pandemic, and yet your EBITDA is higher than it was pre-pandemic. So I'm guessing we're seeing this with a lot of companies. Sort of the stay-at-home or these different sort of protocols and how to work is actually dropping your costs. Is that something?
Yeah, it is. Yeah, it is. That's partly it. There's two things happening with us. That's partly it. Our business development and travel costs have gone way down, which is great. And we sort of redo our 12 and 24 month forecast every 3 months, once a quarter. And so sure enough, in our board meeting a couple of weeks ago, we redid the forecast and our operating expenses. We knew that when we forecast the Q2, we thought people would be back traveling, and they were, but not to the same extent. So we're seeing less travel. That's part of it. The other part of it is product mix, quite frankly. Our larger projects, our larger turnkey projects have a lower margin than when you just sell a piece of equipment. When we're selling a piece of equipment, that's proprietary, so we can get a very good margin on that. So a higher proportion of our business more recently has been equipment only with a higher margin. But we are also seeing significant carbon pricing and carbon levies and carbon taxes coming in most jurisdictions. Canada and the EU, the carbon price is going from sort of $30 a ton up to a high in Canada's case of $170 a ton between now and 2030. The EU is a little bit less. I think it gets up to sort of like $150 a ton. So our customers are taking that into account. A lot of all the projects we do are based on a payback. So we design them on a payback. So if your fuel cost is higher because of carbon taxes, that will result in either a bigger project or perhaps a better margin on the project. We'll have more room to play with. So we should see a bit movement in that way. But for the most part, you're absolutely right. It's due to product mix and lower operating expenses.
And do you see, is that going to be sort of systemic now? Are you going to keep that in place, or how do you address it going forward?
I hope so. I tell the team to always be thinking that you don't always have to go and visit them, but we'll have to see. I'm certainly never going to stop guys, from going to visit our customers. But we'll have to see. If I had to guess, it's hard to know. If you haven't traveled for a year, then as soon as the restrictions are lifted, there will be a pickup in travel. But so far we haven't seen it. Like I said, from August through November, most of our markets you could travel almost anywhere, and we didn't see the same level of travel that we had in the past.
Gotcha. Now, you mentioned obviously the change in the administration in the U.S. at the federal level. Obviously a lot more environmentally friendly. But do you see anything concrete in place right now that could be affecting your business? Any sort of changes in legislation or anything that you anticipate that might have a direct impact?
Yeah, not just intentions. At this point, it's intentions. So. If you saw some of the headlines in the slides there, the Biden administration has already rejoined the Paris commitment, obviously, which has where they're agreeing to reduce their carbon emissions. There's been other headlines where have said, the recovery program is going to be, very focused on green jobs and carbon emission reduction. And they said the White House staff is the greenest White House staff there's ever been. Then you've got the more recent UK, UK has just in the last 2 months has increased their target for carbon emission reductions from 40% to 68%. And the EU has increased from 40% to 55% reduction. So we're seeing a lot of that. I can't point to any individual, law right now, but it's just a general desire. And we're seeing it proactively from our customers as well, where they are much keener to sort of roll out and quickly roll out energy saving measures. And part of that is driven not just by the increasing cost and wanting to reduce carbon emissions, but investors too. You know, if we saw with the announcement from BlackRock, investors, these large investment managers are placing increased emphasis on ESG reporting and targets to reduce carbon emissions. So, you know, if the shareholders are demanding it, the customers will come for sure. And then, Paul, on your previous question about lowering operating costs, I do believe, you know, we're a small multinational company that travels a lot all over the world. So I do believe there will be a long-term savings because it's not just our sales guys, but our customers too are much more receptive to video calls. Like I said, everybody in the company now has Teams. They can set up a video call on a moment's notice. So, and our customers are more used to it as well. So I think we will, but we'll have to see.
Yeah. No, I see it everywhere. I think this idea of, you know, now, you know, jumping on a Zoom call like this to do something like this, we didn't see as much of it a year ago. And of course, now everybody knows how to work Zoom and Teams and you name it. So I think it'll be with us for a while. You guys, you know, you have a healthy balance sheet. You have $4.9 million in cash. We sort of touched on it a while ago that you know, you guys are looking at opportunities, but maybe explain away what you really plan to do with the cash. Are there some M&A opportunities, or is it really just to sort of bulletproof the balance sheet?
It's at this point, it's to bulletproof the balance sheet. You know, until we get some, you know, we're not quite there yet. As I said, we had a strategic session with our board just last week, and you know, we believe there's light at the end of the tunnel, but I think we just want to see how it plays out over the next little while. But we do have a couple of things that we're thinking about doing it as well. You know, we don't plan as we have in the past. You know, it's sort of a balanced approach. We want to grow. You know, we could use the cash to make an acquisition. We could use the cash to hire more people. That would affect in the short term the profitability. So we want to grow in a balanced way. We want to maintain our profitability. We want to be profitable. But we've also been, you know, in the past, we've had a normal course issuer bid. You know, that's something we would consider in the future. Again, once we're 100% out of the COVID and we're feeling pretty positive that we won't need that cash, we can start thinking about what we're gonna do with it. We don't have a desire to keep that level of cash on the balance sheet.
No, fair enough. You know, we always sort of ask about new products, new initiatives. I think we touched on it last time we spoke, but where's your mind in terms of where you want to innovate, or you know, any new products that you guys are currently working on?
Yeah, it's gradually we're looking at a number of areas into the sustainability space. So, you know, carbon neutral, and you know, you can reduce energy efficiency, you can improve energy efficiency to a certain degree. You know, long term, and I'm talking out 20 years. You know, there's going to be more opportunities in renewable or sustainable energy that is carbon neutral, and that's, you know, our Dryrex product is one of those. That's a dryer that we've had for a while. We continue to try and develop it, and will be developing it. That's where you can use biomass. Biomass is a carbon neutral fuel source where you use waste heat to dry the biomass. So there's a number of opportunities like that. There's also thermal storage capabilities. You know, thermal energy is our focus. Part of the challenge is, you know, I think I've told you before, when we go to a site, we identify a heat source and we have to identify a heat sink. And the heat source is always way bigger than the heat sink. So if you can take that heat and either store it for later use or turn that waste heat, you know, into electricity, then the heat sink becomes much bigger. And so that's an area that we're looking at as well, you know, being able to either store that thermal heat or use that low grade thermal heat to turn it into electricity and put it out into the grid.
Fantastic. I mean, maybe generally give us a sense of your pipeline. Where's the low-hanging fruit? Is there any geographical areas that you think are more likely to bring you business? What can you tell us?
Yeah, I would say no. I mean, it's equal everywhere. It's North America, primarily the U.S. and Europe. Strategically, we are focused on trying to grow more in Europe than we are in North America, primarily because we've pretty much got an established footprint in North America. And whereas we don't in Europe. We don't have anybody in France, we don't have anybody in Spain. Those are some of the larger economies. But also in Europe, the fuel price, the energy prices are sort of 2 to 3 times more than they are in North America. So the opportunities are much greater. So strategically, we're focusing on growing our business in Europe. Having said that, we see, the pipeline of opportunities is pretty strong in North America as well. So we think our business, roughly speaking, will continue to sort of be 50-50.
And I can't remember if you actually mentioned it in your pitch deck, but maybe remind everybody, like some of the payback on some of these installations is pretty robust. You guys get some pretty good, customers get some pretty good payback on their cost to install.
Yeah, it's usually, I mean, it depends. It's industry by industry. And so, but most of our projects are between a 2 and a 5 year payback on a project that will last 30 to 40 years. So it's a very good IRR. But also, what you have to realize is that there's diminishing returns for every unit of energy you save. So as an example, we might go to a customer and say, we can save you $1 million on your fuel bill. It'll cost you $2 million. Or we can save you $3 million, but that's gonna, let's see, we can save you $1 million and it'll cost you $2 million, or we can save you $2 million, but that'll cost you $6 million. So the payback goes from 2 years to 3 years because that diminishing returns on that extra amount. So what we're starting to see, and so that often that limits the projects, but what we're starting to see is customers increasing their, payback requirements, so they get easier to meet. So whereas before they might wanted a 2 year payback, now they might go 3 or 4 years. So that's what we're starting to see. But every project we design, it's designed to their return requirements. So we meet with the customer and they say, well, how much is it going to cost? And we say, well, what are your return requirements? What are your investment hurdles? What do you need? We can work with you to deliver a project that meets your hurdles. If you want to lower your hurdles, we can save you more energy. So.
ESG is very topical. There's been absolute phenomenal returns in the space. You pointed out in sort of some of the metrics that you guys are trading at. I still believe you're one of the cheaper, profitable ESG companies out there. But we've also seen your share price, bounce quite a bit from the lows that we saw, mid-year. Maybe give us a sense. Are you getting, you must be getting more phone calls. You must be getting, maybe some institutional interest. Give us a sense of the type of investor interest you've seen so far.
Yeah, it's been very strong over the last, really just the last month. Started in December, really, and that's where the share price started to go up. But and I think people are coming to the same conclusion you are, Paul. If you look at the comparables, even the ESG sector has been on a tear recently, but when you look at the comparables, we're a fraction of the valuation metrics of everybody else. But even if you discount that, even in normal times, the multiples I'm showing you here on the screen, 1.3 times revenue. That's at the recent high price where it closed at yesterday at 20 cents. So it closed down today, I think it's 16 or 17 cents. So, now it might be below 1 time revenue and normal pre-COVID revenue, and below 10 times EBITDA for a company that's growing their EBITDA and has positive EBITDA. I look at some comparable companies in similar spaces, and they're forward looking, the forecasts 3 years out, EBITDA multiples are still way ahead of what our current EBITDA multiples are. So I think it's the current valuation doesn't reflect our success and the growth that we've delivered, the profitable growth that we have proven over and over again over the last 5 years to grow consistently at these sort of levels. So, and for that reason, it's good to be finally seeing some attention because I think we've flown under the radar for the longest time, but I still think there's lots of upside.
Mm-hmm. Yeah, no, I reiterate here, you're a solidly growing company with high demand for your products, in a hot sector and very, very reasonable metrics. So I think I would emphasize everybody should take a good look at the comparables and do a good analysis to understand where thermal energy sort of fits in the valuation scale here. We sort of covered most of the stuff we need to cover here. Do you maybe give us a key takeaway that our listeners should should really leave this presentation with today, as far as maybe sort of what you see as the company's progress over the next 6 to 12 months, or any key message you think they should know?
Yeah, it's really the bottom bullet points on this slide. Invest now. I've had this slide up for a couple of months, and quite frankly, when I saw the share price yesterday and it shot up to 21 cents, I thought, oh, gee, maybe I'm going to have to change this. And I looked at it and I realized, no, we are still undervalued. So, I would just encourage people to look at the proven performance, the proven profitable growth that we have delivered, and look at the markets in terms of the significantly increasing demand for carbon emission reduction technologies around the world. And 3, look at the comparable companies, and that we are trading at a fraction of the multiples that most similar companies, comparable companies, are in this space. So I think it's a good value. It's a value investment with growth, right? So it's both growth and value. So
it's pretty rare to find in these times. That's awesome. What's your website address in the event that somebody wants more information? Actually,
absolutely, www.thermalenergy.com.
Perfect.
And
yeah.
If anybody, I encourage people to reach out. We'd be happy to provide them any more details they want. So there's a spot on the website where you can sign up for investor information, and if they do that, we will be in touch for sure.
Perfect. Today we've had Bill Crossland, CEO of Thermal Energy. Bill, it's always great to catch up with you. I really want to appreciate the time you've had with us, and continued success.
Thanks so much, Paul. I appreciate it.